We're going to keep the Cebu 2022 thing rolling along. I'm excited to introduce Joanna Ossinger, past president of Cebu with Bloomberg News. We have an exciting panel on crypto. She is joined, and I will let her do the proper intros, by Adam Levine, John Wu, and Noel Atchison. And I'm looking forward to this, so take it away, please.
Hey, thanks, Caleb. Really appreciate it. And it's so great to see a nice turnout. It's very exciting to be at the in-person panels, so thanks very much. So I am Joanna Ossinger with Bloomberg News, and I actually cover crypto pretty much full-time at this point. And it's a very topical thing today, in the past week or so. So hopefully we'll give you guys some good info. So Noel is the director of market insight at Genesis, and John is the president of Ava Labs, and Adam is vice president of corporate strategy at Fireblocks. And I would like, just since not everyone might know, if they can talk a little bit just briefly about what each of those firms does. So Noel, if you can start.
Okay, I will just say, wow, what a day to be talking about crypto. My name is Noel Atchison. I am Director of Market Insights at Genesis, as Joanna said. Genesis Trading. Genesis is the largest digital asset prime broker in the space, focusing on institutions. We're the oldest OTC desk. We're the largest institutional crypto lender, and we are also now one of the largest derivatives desk. We have offices in New York, Singapore, and London, and we work with a very wide range of high net worth individuals, ranging through different geographies as well as through different types of investment. I get to spend my day trying to figure out what's going on in markets, so I haven't slept much over the past few days, as you can imagine. I look at the short term and the long term, and my job is to help investors understand what's driving value, separate the signal from the noise, and wow, is there a lot of noise? I would say it's a pleasure to be here today, to meet all of you, to be with such amazing panelists, as well as Joanna, who is one of the foremost crypto journalists in the industry. In spite of what she said, it's not the only thing she covers as well.
Yeah, John.
Thank you. Good afternoon. My name is John Wu, president of Ava Labs. That's the team behind Avalanche, one of the top 10 cryptocurrencies on CoinMarketCap, if you look at it that way. The blockchain itself is one of the fastest blockchains out there in terms of speed and finality, but also in terms of growth and adoption by users. And I spend my days basically aligning the different parts of the firm, from product to marketing to the engineering team and to the business development team. And it's fascinating because I came from an investing background where I basically invested some early stage various tech type companies, and to learn the new ways of operating using the old frameworks. And it's a lot of fun. And I work with great people.
Excellent. Adam?
Perfect. Thank you to Cebu. Really appreciate it, and for everyone to come out. So at Fireblocks, I head up corporate strategy. Fireblocks is the leading digital asset infrastructure technology provider. We support and help power over 1,200 institutional clients globally, really giving them the technology that allows them to hold their digital assets in the safest way possible, and then connect to exchanges, DeFi protocols, and all the other weird and wonderful things that you could do with crypto and or digital assets. So the company is headquartered out of New York, although the cyber strength and technology comes from our R&D team out in Tel Aviv. And within my role, I get to focus really in 3 areas. The first is around strategic partnerships. The second is thinking about non-crypto digital assets with a real focus on central banks and market infrastructure. And the last is our new ventures.
Okay, thanks. So let's get into it. It's been a couple really interesting days here because Bitcoin has dropped below 30,000. It peaked around 69,000. We've had basically the failure of a peg of the Terra USD stablecoin, or algorithmic stablecoin, and just a lot of movement in the markets. So Noel, what's been really interesting for you about the past couple days? What do you think is a good takeaway, or something that you think is really important?
Well, first of all, what hasn't been interesting over the past couple of days? This really has been one of the weeks for the history books, and I'm not exaggerating at all there. It was epic. I've been covering crypto through the institutional lens now since 2016, so I've seen some bloodbaths, but really nothing like this week. I mean, just to put things into context, in the March 2020 bloodbath, over the infamous week of March the 11th, the crypto market cap lost $70 billion. We lost more than double that in one day yesterday, and over the past 7 days, the market has lost over $500 billion. That's billion with a B. This just puts into context the scale of what we have seen. But the big difference between this and other big crashes that crypto has had over the years is that this is not crypto specific. Obviously, the UST depeg is a crypto isolated incident, but it wasn't driven by purely crypto factors. The markets have been very rough, as you all know very well. And this has been brewing for some time. My big takeaway is that the UST depeg and the sort of near almost disappearance of one of the top 10 crypto assets from the tables is not the main story. It's the most dramatic story. You know, come for the drama, stay for the value, or come for the value, stay for the drama. You can take your pick these days. But it's a chapter in the story that has been unfolding since the beginning of the year. It's that point in the plot line where things get really tense and that moves the story forward. So yes, it's been dramatic, but it's a chapter in the evolution of the integration of crypto in global markets that we have seen for the past 2 years, but accelerated over the past year, and not necessarily in a positive sense, because let's face it, there's not a lot positive going on in markets.
Yeah, John, what's been interesting for you?
It's amazing because when I, as an operator, seeing it unfold from the ground level, it kind of reminded me, I had the benefit of being an investor before I became an operator. But what was interesting was it was kind of like I saw this movie before. And a stable coin, an algorithmic stable coin, somewhat similar to an emerging market currency back in the day, pegging itself to the US dollar with the hope of ultimately the purpose of it basically is that the emerging market economy cannot withstand the volatility of the currency, and usually emerging market countries are very trade oriented, so the import-export would be really hurt and there would no stability for the economy. So the best thing you do is you tether it to the US dollar, and you hope that will give the stability for your trade and ultimately give you more stability in your economy. And we've seen our share of emerging market currencies that depeg, because you don't control the monetary supply, and there's duration mismatch between your interest rate environment, but you're pegging your currency to a different country who has a different monetary situation or economic situation. So when I saw this unfold, it was like, wait, I've seen this movie before. And the difference here, though, and this is the most important takeaway that people are not going to take from this, and they're going to focus on the negative, is that although the result is not what you wanted, it's kind of working ultimately. The downside is kind of working because the big problem in 2008, and if you look at the Lehman crisis, the biggest problem was that there was no transparency. There was no mark on the assets. You had no idea how exaggerated the leverage in the system was, and there was no liquidity. Here, with this 24/7 market and the way the blockchain is set up as a ledger, there is transparency in the sense that you know where the money is moving, and there is a liquid market. So instead of having no marks on those, toxic debt on the Lehman books, and then the rehypothecation that happened, you kind of could get out of the situation, and that's what's happening. The prices and the assets are moving, but it kind of worked in a weird way. Not the end result everyone wanted, but this is the whole benefit of having transparency on a blockchain.
Okay, interesting, thank you. And Adam, what do you think is big?
Yeah, so we really see that stablecoins have tremendous utility, whether it's in the individual retail use or in the way commerce functions. Part of what we're hoping, not the way you want it to go, but there's going to be a focus on the quality of the stablecoin to make sure they're stable, not unstable stablecoins. Now, whether that accelerates the idea of having regulation on these coins that comes out of this, that would be a good positive externality, not the way, as we were discussing before, not the way you'd want to get there. It's usually not a good thing when the market's saying, hey, we need regulation, right? But this may be a good example where things can be done better. And the longer term view of what you could actually do with this technology, people need to stick with that vision, right? This is not about just jumping on alpha or trying to make a quick gain. There's real opportunity if we leverage the technology and the coins are created the right way, the right mechanisms, the right risk metrics behind the scenes will actually help everyone quite a lot.
Yeah. Okay, so what does this mean for things like institutional adoption and even retail? Are people going to be freaked out by this and get out? Or is it going to still be part of the plan to continue in crypto and digital assets in blockchain where it's useful? So,
Both. To say both is the simple answer. But yes, people are going to be freaked out. I mean, the last few crashes we've had, they take some time to recover from that kind of pain. We can't overlook that there's been a lot of investor pain at the institutional, also the retail level, which is sort of something the regulators are definitely going to, as Adam hinted, going to be looking at. But is it over? No, by far no. We've been through crashes before, and that is when things get interesting. I've covered both the ups and the down times, and I can say, with respect to the pain that people are feeling these days, the downtimes are more interesting because the froth is removed from the market, the focus gets honed with even more clarity, and it is easier actually to get things done. We all know that the value that underlies this technology, the innovations that we've been seeing building, is still there, and after what we've learned over the past few weeks is probably even stronger now. One thing that we've mentioned here is the transparency, and that has allowed us to experiment with economic incentives in real time at a scale that we have never been able to do before. The UST Luna experiment did not work. We know a lot more now than we did even just a week ago. That does not mean that the innovation is over, and that does not mean that we're going to keep on trying to figure out how to embed decentralization in an efficient and productive way in some fairly risky concepts. It's risky for sure, but that's innovation always is. So both, there will be pain, people will be staying away for a while until they start to see the industry continue its progress. Many will stick, many are long-term holders, and many think that I don't really care what the price does every day, I am here for the longer-term value, I understand the revolutionary potential here.
yeah, John?
In 1999, 2000, there were probably like 15 search engines out there. And after the crash of the internet bubble, there ended up being a handful. And what happens is basically the Googles pop out, the true innovators, the people who can focus on building and creating new things, and the technology starts to shine. In the short term, Joanna, I think yes, the innovation will slow down a bit and the institutional adoption will slow down a bit. But in the medium to long term, it's actually, I think Noel said it in the green room, was kind of cathartic because now you're left with the real builders. And I think ultimately it's actually a good thing. As long as the regulators have sensible regulation. If they use this as an excuse to overregulate, we will lose that innovation in this country and you'll see it overseas somewhere else.
Okay, Adam.
Yeah, so one thing to think about for retail users is, when everyone's leaving, often that's a good time for an investment opportunity. The other bright side is my mom keeps asking me for an inside tip on Bitcoin, and now I can prove to her that I have no clarity on that. So for retail users, those that were freaked out, they may take the view of, okay, I need to wait, or some of them may say now's the time to buy instead of when it was at 48,000 or 52,000 for a Bitcoin. It's too soon to say with clarity about how our clients are starting to react. I'd be pretty surprised if we see any of the bigger projects now slow down just because of what's happened in the last few days, right? Their use cases, the variety of things that you can do with this technology is not pegged to one very material impact that we've had in the last week. Obviously, they're going to maybe think a bit carefully or different than they would before, and I think that's probably a good thing for the economy and for just users to be thinking a little bit more critical about the types of projects that they're going through, what they're trying to achieve. So that may be a positive part of this, but I'd be surprised if we see innovation really slow down, although there's obviously a little bit less money to invest in these things right now.
Well,
Right.
Truth in Advertising, our respective firms are working and collaborating together, and if we're just one firm, but we're not slowing down our partnership at all.
Nice. Okay, so I would love to hear from each of you one thing that you think is really an up-and-coming trend, and of course, there's so much in motion right now, but just kind of, the next 3 or 6 months, what is going to be bigger in crypto at that point than it is now? Noel?
Everything I say is my opinion, not that of my employer. Nothing I say is investment advice, but Bitcoin. There are many other projects also that are fascinating. Avalanche is certainly one of them. And there's a lot of innovation that is necessary to help push finance into the next generation. We know it needs that. But I'm going to say Bitcoin, not just because it has time and time again shown that there is a strong support, a strong floor to the drops it's had in price. And why is that? Because just reading the headlines over the past few months, the world is becoming more aware of the need for a decentralized long-term store of value. It's not just seeing Europeans fleeing with what they can carry. It's not just seeing the bank accounts of citizens of a relatively free democracy being frozen because of their choice in donations. There are many instances, without even going into the inflation that some economies outside the United States are seeing. The underlying value premise, the value thesis, the investment thesis of Bitcoin has not changed, and it is certainly a lot cheaper at these prices. So that is one that I personally can be very confident on. And the DeFi work that's going on, that is going to become more apparent over time.
Okay, and of course, Bitcoin was what, 3,500 just a few years ago. So still, 28,000 is still not so bad if you look at it that way. John?
I don't know if this is going to be, the right word is bigger, but what will be better for sure, I think in the next 6 months, is that the user experience and developer tools will improve. I know at Ava Labs, the team that does Avalanche, we're already helping users access, DeFi and access chains a lot easier with user interfaces that are probably more akin to that of a Schwab account or something like that. From a developer perspective, we're developing blockchain as a service, tools or subnets, we call them, that allow developers easily to code and to get access to blockchains and to be innovative. It's almost like Shopify for e-commerce. You can just drag and click, and all of a sudden you can have your own blockchain for your specific execution environment. So I think the builders will continue to innovate, and I think the next step in the next 6 months to a year is creating easier access and better tools.
Nice. Adam?
So John stole one of mine. I totally agree with that.
The Fireblocks is helping do that as well.
So the other thing I expect more of is commerce using stablecoins, and it's going to impact all of us on the retail level, not just on the wholesale institutional commerce. I very much see that in the retail use case, especially, people realize they can make payments quicker, cheaper, with less risk, right? Using the right type of stablecoin. We're seeing a lot of initiatives there, and I think it's going to benefit everyone.
Okay, thank you. I think at this point, I will open it up to questions from the audience. Yes. And if you can state your name and affiliation. Hey.
Hi, my name is Diana Lee. I am a master's student at NYU Business Journalism program, but I've also been covering wealth management for Horizon this spring. And one of the biggest news we covered recently is Fidelity trying to incorporate crypto into its retirement account, but there's been a lot of pushbacks from the Labor Department. I was just wondering, as industry insiders, what are the sentiments out there to kind of push that into the traditional corner of finance and make much more mass adoption than it is right now, especially considering the recent volatile market conditions right now? Thank you.
I can answer that. So I think people forget that the crypto asset class is one of the few asset classes where the retail front ran the institution. So Fidelity and Abby Johnson's actually just listening to her client base, and she's providing it for them in a 401k format. The recent pushback was when I think Senator Warren came out and basically said that that's too risky and they shouldn't do that. But for every senator that wants to create a negative narrative to further their agenda, there's another senator, Tuberville from Alabama, who actually tried to impose the Financial Freedom Act so that people can have free choice. So reality is, the nature of crypto and the ethos of crypto is to let the individual choose. So at some point on a greater level, we all have to think about, do we want government involvement or do we not want government involvement?
I'll add something on to what John has said, and it's, yes, do we want government, not government involvement? How much do we want the governments telling us what we can and cannot do with our money? They do need to protect retail investors from asymmetries of information, for sure. But that is fairly easy to solve. Just make sure that the investors have the information they need and let the individual decide. This is, as John pointed out, very much the crypto ethos, and this is one of the most fascinating aspects of working in this industry right now. The philosophical battle that is being waged at the highest levels to identify what we mean by privacy, what we mean by freedom of choice, and what we mean even by decentralization.
Very true. Yeah. Yes.
Hi, I'm Bernie Cohn from Bloomberg. John, I'd like to come back to the regulation string and stay with your comments from before. Where are the areas in your mind that are either okay or even desirable for regulation, and for you at least, where are the red lines?
So most operators in this space really want sensible regulation. And I think you start with what Noel said, consumer protection against frauds, and other Ponzi-type schemes. So I think there is the right philosophical belief to protect consumers from getting defrauded. With that said, unfortunately, the way they're going about this is using constructs that were built literally like 90 years ago, before even the digital age. When you have the Securities Act of 1933, 1934, and I mean, those things were done really before even zeros, ones, and digital age, and they're constantly trying to patchwork that up. So it's really hard for regulators ultimately to catch up, and that's kind of what's happening. The specific areas I think that would be helpful for consumers would be, I think, the stablecoin situation. It's great. I think Yellen had the right idea by saying this should be investigated, not ban it. It should be investigated and understood more. She seems like she has a level head on her shoulders. After that, I think you have to think about its stablecoin's role in decentralized finance, because there are incredible yields there. Why are those yields there? There are two reasons. One is because you cut out intermediaries who take a vig every time they're involved, but there's also a lot of incentive schemes out there. And you have to decide whether those incentive schemes are kosher or not. I mean, if it's kind of like the internet age where you're giving out free things and losing money in order to acquire customers, I don't think that's a problem. That's a capital market function. If applications or projects want to rely on the capital markets to fund their acquisition of customers, that's fine until they run out of money. But if it is a defrauding type of scheme where whales get to eat the minnows or sharks eat the minnow, whatever the analog is, then it's not okay. So, and I know a lot of hands went up, but you guys do know that we're the only thing holding you up from lunch, right?
Yeah.
Hi, Karen Ho. I'm a freelance reporter. So my question is in regards to crypto's climate impact. There's increasing amounts of attention on energy demands from the crypto industry and how it contradicts a lot of initiatives to lower energy use in response to the recent IPCC report. And it's understood that crypto mining is increasingly consuming a large amount of energy in areas of the world where energy access is either inconsistent or under severe threat. And I wanted to know, on an institutional basis, as more institutional investors are looking at things like ESG metrics and how this energy drainage contradicts those requirements, how is the industry addressing this growing issue?
Do you mind? Because this.
Yeah.
So we very much at Ava Labs and Avalanche care about that subject matter. But I think let's look at the numbers first. A lot of what you're referring to really comes from the proof of work type of mining that happens out there. That's primarily, that's really Bitcoin and Ethereum right now. There's a whole new generation of consensus protocols like the Avalanche protocol, where it is proof of stake. It's more software-based, less hardware. It doesn't require energy from the same level of Bitcoin in order to have that consensus protocol work and to run algorithms to validate, secure a chain. So we actually have spent a lot of money and had consultants come in and do analysis on this. And luckily, the answer is like proof of stake protocols in general are like probably 100 times more efficient. Avalanche in particular, the work that the consultants did was it roughly is the equivalent of running about the 40 US households a year worth of energy. So again, it's relatively small. And we even bought carbon credits to offset that, to make sure we're neutral. With that said, I think the industry as a whole, your question, is moving more and more towards proof of stake. Ethereum is in the process of doing that with their, used to be called E2.0, now called Merge or whatever it's called. It's just going to be slower, but all the new alternatives are far more efficient.
I'll add on to that as well. They are, and the important thing here is choice. There are many more efficient alternatives. Each one does have different security parameters. And pulling this back to Bitcoin, it is arguably the most secure network because it consumes a lot of energy. Security does require energy. Just take a look at our current financial system. But something like Bitcoin, proof of work, is agnostic as to what kind of energy it consumes. It does not care whether it's fossil fuels or whether it's renewables. It cares about efficiency of use, distribution, and the cost. So Bitcoin mining, being one of the most mobile industries, can, unlike any other industry, be used to support the creation, the generation, distribution of more renewables. Most of the miners in the industry, Ethereum and Bitcoin, they are in favor of more regulation about the energy use, and that is totally fair, that is totally fine. That is part of the government's job. We see in Europe, where I live, governments trying to decide which technologies should get used. That is not the government's job. Governments are to regulate outputs, not the technologies themselves. I mean, imagine if 100 years ago we decided that cars consumed too much energy, let's not develop that technology. Where would society be today? So the institutions, to answer your question more directly, that are focused on Bitcoin and Bitcoin mining, they do care very much about this. They care about the climate. This is the world's problem. They also care about the regulation around that. So what I see from my vantage point on the inside looking at this is progress all around. The migration of the mining industry to the United States was a big step forward in getting a cleaner energy mix, and there are many cases of fossil fuel producers now using Bitcoin mining to contaminate less. I could go on, but we'll leave it there. And Adam, if you want to add something to that.
Yeah, a few thoughts. So there are companies that now use renewable energy to do mining. You could argue whether that's the best use of renewable energy, although I think it's a good thing in innovation. The other thing is when you think about ESG, like the S and the G, there's a lot that blockchain technology does to help from social and governance, thinking about DAOs as different ways to govern. That kind of gets lost in the story, and I think it's important. But I think the ESG movement, it's a critical part to make sure that this part of the economy and this level of innovation continues to progress in a way that matters to everyone, right? The fact that all of us think about ESG at all when we go to do our investing in typical equities is great. On a side note, it would be great if the same level of force was pushed on to things like the amount of paper we waste writing checks in our country. The fact that we still use checks in our country is insane. That doesn't take away from the fact that we could do more in the crypto space around the environment. But let's apply that all the way through. The amount of lights that are kept on at big banks overnight in Manhattan, the way we use checks, the inefficiencies with ACH and wire, all of that could be done better too. I'd love that same level of focus there, in addition to continuing to improve this part of the economy.
All right.
Hi, Jeff Timmermans from the Reynolds Center for Business Journalism at Arizona State University. I'm just curious to hear what you guys think will be the next evolution in the peg for stablecoins. We've seen that the algorithmic peg that Terra USD used was not especially strong. Even Ethereum now, a lot of the reserves are held in non-liquid assets. Is there a possibility that we will have more of a strict currency board system for a peg of a stablecoin? And if so, is that even feasible for a cryptocurrency?
I'll share my personal view, not the Fireblocks view. I like the idea of when I buy a token, that there's a dollar or euro or whatever it is that's in some account that's being held, right? I don't really want to play games of, well, 99.823% is in a currency and then the rest we're investing in some other tech. We need to focus in the industry, I think, on stabilizing the stablecoin in the various different currencies, and that will really facilitate commerce and help everyone the most.
And the transparency, sorry, John, the transparency is very, very important. I personally hope that we continue to see experimentation in pegs, that we don't just rely on one particular textbook example, and that experimentation will be transparent. We'll be able to see in real time how it works out.
There should be more experimentation, but in the short term, USDC, which is one-to-one and also audited very properly, will gain market share. USDT has to do more than just have some self-appointed auditor look at their stuff and then proclaim that they are backed by all of this stuff. They're going to have more transparency and have a true third-party regulator really look through their stuff.
Interesting. Okay, who has the mic? Sorry.
Hey. Hi there. All right. My name's Alex Zuccolo. I'm a crypto reporter for Cheddar News. John and Noel, you both emphasized the importance of a certain amount of creative destruction happening as crypto develops. And I'm curious.
I think the word was cathartic, but yeah.
I'm curious what aspects of the crypto ecosystem you would like to see go the way of pets.com. And to be more specific, does this disprove the case for Terra USD and algorithmic stablecoins in general? And if you don't want to speak to that, I'd be curious to hear what other things we haven't thought about, so maybe we can get ahead of the next crash that wipes out hundreds of billions of dollars.
So I think the natural weeding out of players that aren't really providing utility is just generally good for the system. But I also think going forward, maybe this will allow the space to be less tribal. There's a lot of tribalness of people attacking each other, and the whole ecosystem right now is about $1 trillion only. Financial systems around the world, between equities, public, private equity, real estate, fixed income, they've estimated it to be 700 trillion at the peak. Now it's probably a lot lower, but and then if you look at development talent, the whole space has less than, it's in the hundreds of thousands of Solidity and crypto developers. This phone, Apple, the iOS has 3 million developers on it. Android has 7 million. God knows how many web developers are. The space should be less tribal and work together to think about gaining share of the greater tech economy as opposed to against each other. And with fewer players from the weeding out, hopefully that's the case.
And take advantage of what we have just seen, which is the mother of all stress tests. We want to know that any ecosystem that emerges is going to be resilient through stress tests, because we also know they happen. And
that's not over yet. It's ongoing.
Exactly. And that is one of the big takeaways. I don't think any of us actually want to see any particular area fail. We're here for the education. We're here to learn. We're here to see what works. We're here because we know things are changing.
Adam, do you have anything? Or you good? Okay. I think last question time. Go for it.
Hi, my name's Kristen Mossberger. I'm a freelance reporter right now. I used to cover technology, the business of technology. My question is in regards to kind of the retail users or the average person. Has it ever come up in so far as ethical concerns about this gamification of the crypto markets, how easy it is to buy these currencies, and how the retail users and low and middle income people are seeing and really taking the loss and the hit, whereas, institutional investors and folks with money to play with, are not seeing that? And is there anything being done to kind of protect the people that grew this ecosystem?
Education, that's the biggest protection that we can offer. I mean, the alternative would be to limit access, and that is down to what we were talking about before. To what extent do we want to be told what we can do with our savings? GameStop is a fairly good parallel. It was way too easy for many people to trade stocks, and they lost a lot of money. But with freedom does come the risk that you are going to get hurt. The insurance is education. The more people understand the risks, the more people understand the potential value, then the more they will be able to assume in an intelligent way the risks that they are taking.
I would actually say what you raise is a concern, but there's also a strong concern the opposite side, that for the average retail user, crypto is scary, right? They don't actually know how to go about doing it, and they're not doing it just to get some exposure to Bitcoin, but thinking about the immigrant that's working really hard and now doesn't want to go to Western Union to send back their $300 to fill in the blank country. They could do that very easily using some version of a stable coin or other cryptocurrency, and then you explain a QR code to a man or woman in their 50s or 60s that isn't that adept at their smartphone, and it's just not worth it to them, right? I actually think there's a lot more innovation that needs to happen to make payments using cryptocurrencies and digital assets much more simple, right? So that the average retail person can take advantage of the benefits of it. The gamification that you're referring to, I think the education point is really spot on, though.
John, anything?
Yeah, I think education is the key answer. I'd also agree with Adam that we forget the benefits. Yes, heart goes out to anyone who's lost money from a speculative side, but there's actually real utility. Even back in 2015 and 16, 17, the Western Union charges 20% sometimes on this. So there were adoption in the emerging countries, and they look at it very differently than we do. They were actually using it for true payment systems, rails, and this is even before the more advanced, faster, speedier blockchains like Avalanche. It was just like with Bitcoin back in the day. I mean, they used it as inflation hedges. They trusted the code more than they trusted their central bank or their governments. They used it for payments, all of that. So we forget, because we have such a U.S.-centric view, that it was not until like 2020 with the mass adoption in the U.S. that the percentage of populations in some of these emerging countries was much higher than that was in the U.S. And the primary use cases were more utility versus speculation.
Okay, thank you. I think we need to leave it there, but Adam, John, Noel, thank you so much for coming and doing this, and thanks to you all for listening.